Before we dive in, please remember that I am not a financial advisor, and this presentation is for informational and educational purposes only. The world of lending is complex and constantly changing. Always consult with a qualified professional, like a licensed mortgage loan officer or financial planner, before making any major financial decisions. Your specific situation is unique, and this video is not a substitute for personalized advice. You found it. After months of scrolling through Zillow, after countless open houses, you finally found the one. The house with the big backyard for the dog, the kitchen you've been dreaming of, in the school district you need. Your heart is pounding. You've saved up for the down payment, your income is solid. This is it. You submit your mortgage application, full of hope and excitement. A week later you get the call. The loan officer's voice is flat. "I'm sorry, but at this time we're not able to approve the application." Denied. Your stomach drops. All that work, all that dreaming gone. What on earth went wrong? For millions of Americans every single year, this isn't a hypothetical story. It's a devastating reality. But it does not have to be yours. The truth is, getting a mortgage isn't about just having a good job or a decent savings account. It's a game. A game with a specific set of rules and a secret scorecard that lenders use to judge every single aspect of your financial life. They don't teach you this in school. Your parents probably don't know the specifics. And the banks benefit from the mystery. They want you to think it's some unknowable complex formula. But it's not. It's a checklist. And today, I'm handing you the keys to the kingdom. I am going to give you the lender's exact playbook. By the end of this video, you will not just understand their scorecard, you will know exactly how to master it. We are going to demystify the entire mortgage qualification process piece by piece. We're going to break down the exact metrics lenders use to judge you, from the numbers you know like your credit score to the hidden ratios and risk factors you've never even heard of. You will walk away from this with a crystal clear action plan, knowing precisely where you stand and what you need to do to walk into any lender's office with the confidence of someone who knows they cannot be denied. So where do we start? It all boils down to what the industry calls the 3 C's of underwriting. This is the holy trinity for any loan officer. It's capacity, character, and collateral. Every single piece of paper you submit, every number on your application, is designed to answer questions about these 3 things. Let's break them down. Collateral is the simplest one. It's the house itself. Is the property actually worth the amount of money you're asking to borrow? They verify this with an appraisal. We'll get into that later. Character isn't about whether you're a good person. It's about your history of paying your debts. This is your credit report and your credit score, and it tells the lender how reliable you've been in the past. It's critically important, and we will dedicate a huge chunk of our time to dissecting it. But the first C, the one that stops most applications dead in their tracks before a lender even looks at a credit score, is capacity. Capacity is the big one. It's the gatekeeper. In plain English, capacity asks one simple question. Can you actually afford this loan? And here's the secret. They don't care how much money you feel like you have. They don't care if you're a master at budgeting or live a frugal lifestyle. They care about one thing and one thing only, your debt-to-income ratio, your DTI. This single number is the most important metric in the initial stages of mortgage qualification. It is a cold, hard mathematical formula that dictates the absolute maximum you are allowed to borrow, regardless of your income. So what is it? Think of your monthly income as a bucket of water. Every month, a paycheck fills that bucket. Now, think of your debts, your car payment, your student loans, your credit card bills as little holes in the bottom of that bucket. The lender wants to know, after all the water leaks out through those holes, how much is left in the bucket to pay for their new mortgage. Your DTI is simply a percentage that shows how much of your monthly income is already spoken for by your existing debts. Now, it gets a little more specific. Lenders actually look at 2 different DTI numbers. This is crucial. They're called the front-end ratio and the back-end ratio. The front-end ratio is your housing ratio. It's the percentage of your gross monthly income. That's your income before any taxes are taken out. That would go toward your new housing payment. This payment isn't just the loan itself. It's what's known as PITI, principal, interest, taxes, and insurance. Principal is the part of the payment that actually pays down your loan balance. Interest is the lender's profit. Taxes are the property taxes you'll owe to your local government. And insurance is your homeowner's insurance. The lender bundles all of that into one number. So if your gross monthly income is $8,000, and your total pity payment on the new house would be $2,000, your front-end DTI is 25%. Simple enough. But the back-end ratio is the one that really matters. This is your total debt ratio. The formula is simple. It's your new pity payment plus all of your other existing monthly debt obligations, divided by your gross monthly income. What counts as a debt obligation? Anything that shows up on your credit report. We're talking minimum monthly payments for credit cards, car loans, student loans, personal loans, and any other installment loans. They don't include things like your utility bills, your cell phone bill, or your grocery budget. They are only looking at your contractual debts. So let's use that same example. Your gross monthly income is $8,000. Your new pity is $2,000. But you also have a $500 car payment, a $300 student loan payment, and let's say a total of $200 in minimum credit card payments. Your total monthly debt, including the new house, would be $2,000 plus $500 plus $300 plus $200, which equals $3,000. Now you take that $3,000 and divide it by your $8,000 gross monthly income. That gives you 0.375, or a back-end DTI of 37.5%. So what are the magic numbers? What are lenders looking for? For decades, the gold standard for a conventional loan, that's a loan not backed by the government, was a DTI ratio of 28:36. That means they wanted your housing payment to be no more than 28% of your gross income, and your total debt to be no more than 36%. But things have changed. Today, with automated underwriting systems, you can often get approved with a back-end DTI as high as 43%, sometimes even stretching to 50% if you have a huge down payment or massive cash reserves. For government-backed loans like an FHA loan, the guidelines are even more flexible, often starting at 31/43 and sometimes going well over 50%. The power of this number is staggering. Let's imagine two people, Sarah and Tom. Both are software engineers, and both make exactly $100,000 a year, or $8,333 a month. Sarah has been diligent. She bought a used car with cash, she paid off her student loans, and she has no credit card debt. Her total monthly debt is zero. Tom, on the other hand, has a brand new truck with a $700 a month payment, he has $400 a month in student loans, and a few credit cards with a $200 minimum payment. His total monthly debt is $1,300 before he even thinks about a house. When they both go to a lender, even though they have the exact same income, their borrowing power is wildly different. Assuming a 43% back-end DTI limit, the lender calculates that the absolute most Sarah can spend on total monthly debt is $3,583. Since she has no other debts, that entire amount can go towards her housing payment. This could qualify her for a mortgage of maybe $500,000 or more, depending on interest rates and taxes. Now look at Tom. He has the same $3,583 limit, but he already has $1,300 in existing debt payments. So the lender subtracts that from his limit. The maximum housing payment Tom can be approved for is only $2,283. This might only qualify him for a mortgage of around $320,000. That's a nearly $200,000 difference in purchasing power, all because of DTI, even with the exact same six-figure salary. This is why you see people who make less money than you getting approved for bigger houses. They've mastered their capacity. So you've calculated your DTI, you've paid down some debt, and your capacity looks solid. You're ready to get approved, right? Not so fast. Because you could have a perfect DTI and $1 million in the bank and still get an instant denial because of the second, and arguably most misunderstood, pillar character. And by character, lenders don't mean if you're a good person who volunteers on the weekends. They mean one thing and one thing only: your credit report. They are about to pull back the curtain on your entire financial history, and what they find there can make or break your dream of homeownership in a heartbeat. And that first impression isn't your name, your job, or how much you make. It's a single 3-digit number, your FICO score. This isn't just a number. It's the lender's summary of your entire financial character. It's their shortcut, their gut check, their first filter to decide if you're a good bet or a bad risk. Before they even look at your income or your down payment, this number tells them a story, and you need to make sure it's telling the right one. Most people think their credit score is some mysterious, unknowable thing, like a secret recipe locked in a vault. It's not. It's a calculation. It's math. And you can absolutely influence the outcome if you understand the ingredients. There are 5 key ingredients that make up about 99% of that score, and the lender is scrutinizing every single one. The first, and by far the most important, is your payment history. This accounts for a whopping 35% of your score. Think of it this way. If you were going to lend a friend $1,000, what's the very first question you'd ask yourself? It's simple. Does this person pay people back? That is exactly what a lender is asking. Your payment history is the definitive answer. It's a track record of your promises. Every on-time payment is a checkmark in the reliable column. Every late payment is a massive red flag. And not all late payments are created equal. A payment that's 30 days late is a problem. It can drop your score by dozens of points, and it stays on your report for 7 years. A 60-day late is significantly worse. It tells the lender you didn't just forget. You had a sustained problem for 2 whole months. A 90-day late? That's a catastrophe in the eyes of a mortgage underwriter. It signals a major financial breakdown. And things like collections, charge-offs, or bankruptcies. Those are the nuclear options. They tell a lender that at some point you completely walked away from a debt. To them, that's the ultimate sin. So when they pull your report, they are laser-focused on this section. They are looking for a clean, boring, predictable history of you paying what you owe when you owe it. It's the foundation of everything. The second most important ingredient, weighing in at 30% of your score, is something called amounts owed, or more commonly, your credit utilization ratio. This sounds complicated, but the concept is dead simple. It's how much of your available credit you are currently using. Imagine you have a single credit card with a $10,000 limit. If you have a $1,000 balance on it, your utilization is 10%. If you have a $9,000 balance, your utilization is 90%. Here's why lenders are obsessed with this number. High utilization is a massive indicator of financial stress. It tells them you are living at the edge of your means, relying on debt to get by. Someone with a 90% utilization looks like they're one broken down car or one unexpected medical bill away from complete disaster. They have no wiggle room, no financial cushion. Conversely, someone with a 10% utilization looks calm, collected, and in control. They use credit as a tool, not a crutch. The golden rule you always hear is to keep your utilization below 30%. And that's good advice. But for a mortgage, you want to be an A+ student. The people with the absolute best scores, the 800+ club, they often keep their utilization below 10%, sometimes even below 5%. They pay their balances off every single month. When a lender sees that, they don't just see a good risk. They see a financial professional. They see someone who has mastered their cash flow. And that's exactly the kind of person they want to hand a 30-year loan to. Next up, at 15% of your score, is the length of your credit history. This one is all about trust built over time. A lender is trying to predict your future behavior based on your past. Well, a longer past gives them more data and more confidence. Think about it. Who would you trust more? A person you've known for 10 years who has always been reliable, or someone you just met last week? It's the same principle. This is measured in a few ways, but the most important is the average age of all your accounts. An account you opened 15 years ago is incredibly valuable. It's an anchor for your credit score. This is why one of the biggest mistakes people make is closing their oldest credit card once they pay it off. They think, great, I'm done with that one. But in doing so, they just erased their longest-standing proof of reliability. They essentially tear out the first chapter of their financial story. A lender looks at that and sees a shorter, less proven history, which makes you a slightly bigger unknown, a slightly bigger risk. They want to see long-established accounts with perfect payment histories. It's a sign of stability and endurance. The final 2 pieces are smaller, but they still matter. Each accounts for 10% of your score. First is credit mix. Lenders like to see that you can successfully manage different types of debt. This shows you're a versatile and responsible borrower. An ideal credit mix might include what's called revolving credit, like credit cards, and installment loans, where you pay a fixed amount each month for a set period. Things like a car loan, a student loan, or a personal loan fall into this category. If your entire credit history is just one credit card, it doesn't give them a complete picture of your capabilities. But if you've shown you can juggle a car payment and multiple credit cards, all while paying on time, it demonstrates a higher level of financial sophistication. It's like being a multi-sport athlete versus only playing one. Proves you can handle different kinds of pressure and responsibility. And the last 10% is new credit. This category is all about how recently and how frequently you've been applying for new credit. Every time you formally apply for a loan or a credit card, it generates what's called a hard inquiry on your report. 1 or 2 of these once in a while is totally normal. But if a lender pulls your report and sees you've applied for 5 new credit cards and 2 personal loans in the last 6 months, that is a gigantic flashing neon red flag. It screams desperation. It looks like you're trying to plug holes in a sinking ship, opening new lines of credit to pay off old ones, or to fund a lifestyle you can't afford. It makes them incredibly nervous. They think, why does this person suddenly need so much money from so many different places? It signals instability, and instability is the mortal enemy of a mortgage lender. They are in the business of 30-year stability. A flurry of recent inquiries is the exact opposite of what they want to see, and it can be enough to sink an otherwise solid application. So, when that underwriter pulls your report, they aren't just glancing at a number. They are dissecting these 5 categories. They're looking at your payment history to judge your reliability, your credit utilization to gauge your financial stress, your credit length to see your stability, your credit mix to assess your experience, and your new credit to spot any signs of desperation. Together, these 5 pieces paint a detailed portrait of you as a borrower. But the score is just the summary on the cover of the book. What they do next is open the book and read the fine print. The collections, the public records, the charge-offs, the skeletons that might be hiding in your closet. So let's open that closet door and see what a lender is truly terrified of finding. First up, collections. This is probably the most common skeleton you'll find. A collection account is simple. You owed a company money, you didn't pay it, and after trying to get it from you for a while, they gave up. They sold your debt, for pennies on the dollar, to a third-party collection agency. Now, that agency is on your credit report demanding payment. But here's the critical detail most people miss. Lenders see a huge difference between medical and non-medical collections. Imagine you had an unexpected surgery. The bills are confusing, insurance is a nightmare, and a $2,000 charge from an anesthesiologist you never even met slips through the cracks and goes to collections. Lenders get it. Medical debt is often confusing, unexpected, and not necessarily a reflection of your financial character. Because of this, the rules are more lenient. For an FHA loan, for example, medical collections are often completely ignored when calculating your debts. For conventional loans, as long as it's paid off by closing, it's usually not a deal breaker. They see it as a misfortune, not a moral failing. But non-medical collections? That's a different story. That $150 unpaid cell phone bill from 3 years ago? That $500 utility bill from an old apartment? To a lender, that's a blaring 5-alarm fire. Why? Because you made a conscious choice to use a service and then not pay for it. It speaks directly to your willingness to honor a financial agreement. It doesn't matter if the amount is small. The lender is thinking, if they walked away from a $150 obligation, what's our guarantee they won't walk away from a $400,000 mortgage? Even a single recent non-medical collection can get your application denied flat out. And paying it off right before you apply doesn't erase the history. It just changes the status to paid collection. The scar is still there, showing the lender that at one point you defaulted on a promise. A step darker than a collection is a charge-off. This is when the original creditor, your Visa, your Capital One, hasn't sold the debt. Instead, they've basically given up hope of ever collecting it themselves. They've written it off their books as a loss for accounting and tax purposes. This looks even worse to an underwriter. It means the relationship with the original company you had an agreement with is completely, utterly broken. They didn't just sell your debt, they declared it dead. What makes it even more complicated is something called a deficiency balance. Even though it's charged off, you often still legally owe the money. A lender will see that charge-off and demand to know if it has been settled, paid, or if that creditor could still sue you for the balance down the road. An unresolved charge-off is a massive question mark hanging over your ability to handle your finances. Now we move from the dark corners of the closet to the full-on public courthouse records. This is where things get serious. And the king of them all is bankruptcy. A bankruptcy is a legal proceeding where you are declared unable to pay your debts. There are 2 main types for individuals you need to know about. Chapter 7 is a full liquidation. The court sells off your non-exempt assets to pay creditors, and most of your remaining unsecured debts are wiped clean. It's the fresh start bankruptcy. Chapter 13 is a reorganization. You work with the court to create a 3 to 5 year repayment plan to pay back a portion of your debt. You get to keep your assets, but you're locked into that payment plan. For a mortgage lender, either one is a sign of ultimate financial failure. But it's not a life sentence. It's all about the seasoning period. The mandatory waiting time after the bankruptcy is over before you can even be considered for a loan. This is non-negotiable. For an FHA or VA loan, you generally have to wait 2 years after a Chapter 7 is discharged. Not filed but fully discharged by the court. For a Chapter 13, you can sometimes qualify after just 12 months of on-time plan payments, but it requires court approval. Conventional loans, backed by Fannie Mae and Freddie Mac, are much stricter. You're looking at a 4-year waiting period after a Chapter 7 discharge and 2 years after a Chapter 13 discharge. During that waiting period, they expect you to be a model citizen of credit. You must reestablish new, positive lines of credit, like a secured credit card or a small auto loan, and make every single payment on time without exception. A clean slate is worthless if you haven't proven you can write a new, better story on it. Just as damaging, and sometimes even more so, are major housing-related events like a foreclosure, a short sale, or a deed in lieu of foreclosure. These hit a lender where it hurts because it shows you've defaulted on the exact type of debt you're now asking them for. The waiting periods here can be brutal. If you had a foreclosure, you could be waiting 7 years, before you can qualify for a conventional loan again. FHA is a bit more forgiving, typically requiring a 3-year wait. The message from the lending world is clear. If you failed on a home loan before, the bar to get another one is going to be incredibly high. Finally, we have judgments and tax liens. A judgment is a court order. It means someone sued you, they won, and the court has officially ordered you to pay the debt. A tax lien is when you haven't paid your taxes and the government, be it the IRS or your state, places a legal claim against your property. These are different from all the other skeletons. There is no seasoning period for an active judgment or lien. You can't wait these out. They are active, legally enforceable claims against you and your assets. A lender will not, under any circumstances, give you a mortgage if you have an outstanding, unpaid judgment or tax lien. It must be paid in full before or at your closing. Period. Why? Because that lien holder has a legal right to your assets that could come before the mortgage lender's right. And no bank on earth is willing to take that second-place risk. So when an underwriter pulls your full credit report, they aren't just glancing at the score. They are a financial archaeologist digging through the layers of your past. They're looking for a pattern. Is there one medical collection from a tough time 5 years ago? That's explainable. Or is there a pattern of unpaid cell phone bills, charged-off credit cards, and a recent car repossession? That paints a portrait of someone who is a high risk to lend hundreds of thousands of dollars to. It's not personal. It's a risk calculation based on the only data they have, your past behavior. So you've survived the deep dive into your past. Your credit report is clean, or at least the issues are old and explainable. Now, the lender shifts their focus from who you were to who you are today. And that investigation starts with the one thing that pays the bills, your income. But as you're about to see, not all money is created equal in their eyes. To a lender, your income isn't just a number. It's a story. And they are looking for a very specific genre. A long, steady, and predictable biography, not a volatile thriller with a surprise ending. Think of it like this. A lender would rather see a small, consistent stream that has flowed for years than a massive flash flood that appeared out of nowhere. The stream is reliable. You can build on its banks. You can count on it being there tomorrow. The flash flood might be powerful, but it's temporary, unpredictable, and leaves a mess in its wake. They are in the business of funding streams, not chasing floods. The golden rule that governs every income decision is this: stability and likelihood of continuance. They aren't just qualifying the person you are today, they are underwriting a 30-year contract with the person you're going to be. They have to build a case using your past as evidence that your income will continue for at least the next 3 years, and ideally far beyond. This is why a 2-year history is the magic number you'll hear over and over again. It's their minimum standard for establishing a pattern. So let's start with the lender's absolute favorite borrower, the W-2 employee. If you receive a regular paycheck from an employer, where taxes are automatically withheld, you are the gold standard. Your income is simple, verifiable, and seen as highly stable. The lender will ask for your last 30 days of pay stubs and your W-2 forms from the past 2 years. They'll calculate your gross monthly income. That's your income before any taxes or deductions are taken out. If you're salaried, it's simple. Your annual salary divided by 12. If you're hourly, they'll typically use your hourly rate, multiplied by your guaranteed hours, or they'll average your hours over the past few years if they fluctuate. Now, a common fear is, I just changed jobs, am I disqualified? Not necessarily. If you moved from one accounting job to another with a higher salary, that's not a red flag, that's a green one. It shows career progression in the same line of work. The lender sees that as a continuation of your stable history. The trouble comes when you jump from being a nurse to a software developer. Even if your pay is higher, the lender has no 2-year history of you being a successful software developer. They might require you to be in that new role for 6 months or even a year before they're comfortable considering that income stable. To a lender, a track record in a specific field is almost as important as the job itself. But what if you don't fit in that neat W-2 box? What if you're one of the millions of entrepreneurs, freelancers, or independent contractors? This is where the journey gets more challenging. When a lender looks at a self-employed borrower, their default emotion is skepticism. It's not personal. It's just that your income isn't guaranteed by a large corporation. You are the corporation, and they need to be sure your business is a stable long-term success. For this, they will require at minimum your last 2 years of complete, filed federal tax returns including all schedules. If you have a business entity like an S-Corp or an LLC, they'll want the business tax returns too. And here is the single most misunderstood part of qualifying with self-employment income. They are not looking at your gross revenue. They are looking at your net income, after all of your business expenses and write-offs. That brand new truck, the home office deduction, the business trips. Every single dollar you wrote off to lower your tax bill also lowers the income you can use to qualify for a mortgage. Then they perform a critical calculation. They take the net income from the last 2 years, add it together, and divide by 24 months to find your average monthly qualifying income. Let's run a quick example. In 2022, your business had a net profit of $60,000. In 2023, you had a fantastic year and netted $90,000. You feel great, you're making over $7,000 a month now. But the lender doesn't see it that way. They see $60,000 plus $90,000, which equals $150,000. They divide that by 24, and your qualifying monthly income is $6,250. They use the average, not your most recent success. And this reveals their biggest fear: declining income. What if in 2022 you netted $90,000, but in 2023 you only netted $60,000? This is a colossal red flag. An underwriter will see this and immediately question the stability of your business. They will likely only use the lower, more recent income of $60,000 to qualify you, or in some cases they may deny the loan altogether, believing the business is in a downturn. For the self-employed, a consistent or rising income is non-negotiable. This same logic of averaging and proving stability extends to other types of variable income. Let's talk about bonuses, commissions, and overtime. If you're a salesperson and a huge chunk of your pay is commission, a lender won't just take your word for it that you'll keep hitting your numbers. They will need to see a 2-year history of you earning that commission. They will then average it over 24 months and add that to your base salary. The same goes for the nurse who consistently works overtime. If you've done it for 2 years, they'll average it and count it. If you just started picking up extra shifts 6 months ago to save for a down payment, in the lender's eyes, that income doesn't exist. It's a flash flood, not a stream. What about other sources of money? Rental income from an investment property can absolutely be used, but with a haircut. Lenders know that properties have vacancies, repairs, and management costs. So they will typically take the gross monthly rent and multiply it by 75%, using that discounted figure as your qualifying income. For income like child support or alimony, it can be counted if you can provide the legal documentation like a divorce decree stating the terms and proof that you have been receiving consistent, timely payments for the last 6 to 12 months. Critically, the payments must also be set to continue for at least 3 years from the date of your loan closing. Finally, there is income that is simply invisible to a lender. That cash you earn on the side doing handyman work? If you don't declare it on your tax returns, it doesn't exist. It's ghost money. That amazing new job you're starting in 2 weeks with a 50% raise? The income is not real until you have a pay stub in your hand. In most cases, you need at least 30 days of pay from the new job before that income can be used. And a large, one-time gift from a family member, while helpful for a down payment, is not income. It was a one-time event, the very definition of a flash flood, and cannot be used to show you can make a monthly payment. So you've meticulously documented your last 2 years. You've proven your income isn't a fluke. It's a steady, reliable river. You've passed the first major test. But the lender's next question is, how many dams and diversions are already draining that river before it ever reaches them? It's a simple ratio with a complicated name, and it's arguably the single most important number in your entire application. It's called your debt-to-income ratio. and it's where most mortgage dreams live or die. So let's break down this gatekeeper, this all-important number. Debt to income, or DTI, is exactly what it sounds like. It's a percentage that shows how much of your monthly gross income, that's your income before any taxes or deductions are taken out, is used to pay your monthly debts. Lenders look at this number to gauge your ability to manage monthly payments and repay the money you plan to borrow. They see it as a direct measure of financial stress. The higher your DTI, the more stressed your budget is, and the riskier you look in their eyes. Now, it's not just one number. Lenders actually calculate two different kinds of DTI. The first is called the front-end ratio, also known as the housing ratio. This one is simple. It only looks at your future housing expenses. The lender takes your potential new monthly mortgage payment, and this is key. It includes the principal, the interest, the property taxes, and the homeowner's insurance, a combo we call PITI, and if you have them, homeowners association or HOA fees. They take that total monthly housing cost and divide it by your gross monthly income. For example, if your gross monthly income is $6,000 and your new total PITI payment is estimated to be $1,800, your front-end ratio is 30%. Simple enough. But it's the second number, the back-end ratio, that really matters. This is the big one. This is the number underwriters truly obsess over. The back-end ratio takes all of your monthly debt obligations, adds them to your new proposed housing payment, and then divides that total by your gross monthly income. So what counts as a debt obligation? We're talking about anything that shows up on your credit report. Car loans, student loans, personal loans, and the minimum monthly payments on all of your credit cards. It also includes court-ordered payments like alimony or child support. Things like your cell phone bill, utilities, or car insurance generally don't count because they aren't considered debt obligations in the same way. Let's go back to our example. You make $6,000 a month gross income. Your new mortgage payment is $1,800, but you also have a $400 car payment, $300 a month in student loans, and a total of $100 in minimum credit card payments. We add it all up. $1,800 for the house, plus $400 for the car, plus $300 for the student loans, plus $100 for the credit cards. That's a grand total of $2,600 in monthly debt. Now, we divide that by your $6,000 gross income. Your back-end DTI is 43.3%. That percentage, 43.3%, is the number that will echo through the halls of the underwriting department. It tells the lender that for every dollar you earn before taxes, over 43 cents is already spoken for by debt payments. This is where the lender's guidelines and their risk tolerance come into play. They have specific thresholds you cannot cross. So what are the magic numbers? What DTI will get you approved? Well, it depends entirely on the type of loan you're getting. For a conventional loan, the kind backed by Fannie Mae and Freddie Mac, the old-school textbook answer was a 28-36 ratio. 28% on the front end, 36% on the back end. You will still hear this quoted sometimes, but frankly, it's outdated. The reality is, with the power of modern automated underwriting systems, or AUS, these limits are much more flexible. Today, for a conventional loan, a back-end DTI of up to 45% is very common. In some cases, if you have what are called compensating factors, like an excellent credit score, a large down payment, or significant cash reserves left over after closing, the system might even approve you with a DTI as high as 49.99%. But anything approaching 50% is walking a very, very thin wire. Now, let's talk about government-backed loans because their rules are different. For an FHA loan, which is popular with first-time homebuyers because of its low down payment requirement, the guidelines are more generous. The standard is often quoted as 31/43. But again, the automated system is king. With strong compensating factors, an FHA loan can be approved with a back-end DTI, all the way up to 56.99%. That is a huge difference. It means someone who was flat-out denied for a conventional loan might sail through an FHA approval. This is often why a lender will pivot a borrower from one loan program to another. They aren't just picking randomly. They're trying to fit your financial picture into the box with the most forgiving rules. Then there's the VA loan, for eligible veterans and service members. The VA is unique. Officially, the VA itself doesn't have a hard DTI limit. Instead, they focus on something called residual income. They want to see that you have a certain amount of money left over each month after paying all of your major expenses, including the new mortgage and your other debts. The amount you need depends on your family size and where you live in the country. However, and this is a critical piece of information, while the VA may not have a DTI limit, the lenders who issue the loans almost always do. They call it a lender overlay. Most lenders will impose their own back-end DTI cap on VA loans, often right around 41%. So even though the VA is flexible, you still have to satisfy the bank that's actually giving you the money. So you can see your DTI isn't just a number, it's a key that has to fit a very specific lock. A DTI of 48% might be an instant denial for a conventional loan, but perfectly acceptable for an FHA loan. This is why knowing your numbers is so critical before you even start looking at houses. And there are some dangerous traps hidden inside the DTI calculation that can completely derail an application. The first and biggest is student loans. This is a nightmare for a lot of buyers. Let's say you have $100,000 in student loans, and they're currently in an income-based repayment plan, or even forbearance, so your monthly payment is $0. You might think, great, the lender will count $0 towards my DTI. Wrong. That's not how it works. For conventional loans, if your credit report shows a $0 payment, the lender must use 0.5% of your total loan balance as your monthly payment. In this case, 0.5% of $100,000 is $500. That's $500 a month added to your DTI calculation, even if you aren't actually paying it. For FHA loans, it used to be 1%, which would be $1,000 a month, an absolute DTI killer. The rules are constantly changing, especially with new federal repayment plans, but the bottom line is, you cannot assume a zero payment will be counted as zero. Another huge trap is cosign debt. Let's say years ago you co-signed on a car loan for your brother. He's made every single payment on time for 3 years. You haven't paid a dime. But because your name is on that loan, that entire monthly payment, let's say it's $500, counts against your DTI. It doesn't matter that he's the one paying it. To the lender, you are legally obligated to pay it if he doesn't. Now there is a way out of this. If you can provide the lender with 12 months of canceled checks or bank statements from your brother, proving he was the one who made every single payment from his own account, most conventional loan underwriters will agree to exclude that debt from your DTI. But getting that documentation can be a hassle, and if you can't, that loan could be the difference between approval and denial. Your DTI is the mathematical expression of your financial leverage. It's a snapshot of your obligations versus your earnings. Getting this number as low as possible is one of the most powerful things you can do to strengthen your mortgage application. Paying off a small personal loan or a low-balance credit card right before you apply can have a massive impact. Not necessarily because of the amount of debt you eliminate, but because you are eliminating a required monthly payment. That's the key. The lender is less concerned with your total debt, and far more concerned with your total monthly debt obligations. Killing a $100 a month payment is a direct $100 reduction in the numerator of your DTI equation. So you've mastered your debt. You've calculated your DTI down to the decimal. You know which loan type you're aiming for. But what about the other side of that fraction? The income? You might think your W-2 paycheck is simple, a cut-and-dry number. But to a lender, it's a complex puzzle of stability, history, and probability. And if you're self-employed, an entrepreneur, a freelancer, or rely on commissions and bonuses, you're playing a completely different game, with a completely different set of rules. So, how do you prove your income is stable, reliable, and likely to continue? How do you prove it's good enough for a mortgage? That's what we're breaking down next. Let's start with the simplest scenario, the one lenders see as the gold standard. The W-2 employee. This is someone who gets a regular paycheck from an employer, with taxes taken out automatically. This is you, your life is relatively easy. The lender's primary goal is to verify two things: that your income is stable, and that it's likely to continue. To do this, they'll typically ask for your most recent pay stubs covering a 30-day period, and your W-2 forms from the last 2 years. Why 2 years? Because it establishes a pattern. It shows you've been consistently employed and earning. Now, this doesn't mean you have to have been at the exact same job for 2 years. This is a huge misconception. You need a 2-year history of employment, preferably in the same line of work. If you were an accountant at firm A for 18 months and then took a higher-paying job as an accountant at firm B 6 months ago, that's not a red flag. That's a positive sign of career progression. The lender sees a consistent skill set and an upward income trajectory. But what if your income isn't a flat salary? What about bonuses, overtime, or commissions? This is where it gets a little more complex. Lenders love predictable income. A bonus is, by its nature, not guaranteed. So a lender won't just take your word that you're getting a big bonus next month. Instead, they'll look at your last 2 years of W-2s and tax returns to see the history of these payments. If you've consistently received a bonus or earned commissions for the past 2 years, they will typically average that amount out over 24 months and add that monthly average to your base salary. So if you got a $10,000 bonus last year and a $14,000 bonus the year before, they'd add those together. That's $24,000, divide by 24 months, and add an extra $1,000 to your qualifying monthly income. But if you just started a new sales job 3 months ago and landed one massive commission, don't expect the lender to use that. They have no proof it's repeatable. They need to see a history of it being a stable, continuing part of your compensation. So for the W-2 employee, the formula is pretty straightforward. Provide the documents show a 2-year history, and the number on your W-2 is pretty much the number the lender uses. Now, let's talk about the entrepreneur, the freelancer, the small business owner, the 1099 contractor. If this is you, I need you to listen very, very closely, because the rules of the game just changed completely. You and the W-2 employee are playing in 2 different leagues when it comes to mortgage qualification. The single biggest, most painful mistake that self-employed people make is confusing their gross revenue with their qualifying income. You might be a consultant who billed $200,000 last year. You feel successful. You see $200,000 flow through your business bank account. But the lender? They don't see that $200,000. They don't even care about it. What they care about is the number you report to the IRS after all your business expenses. They care about your net income, not your gross. Let me repeat that because it is the absolute key. Lenders qualify you based on your taxable net income. Think about it from their perspective. A W-2 employee who makes $80,000 a year has very few, if any, business-related expenses. Their $80,000 salary is a clean number. But you, the business owner who grows $200,000, you had expenses. You bought a new work computer, you paid for software subscriptions, you have a home office, you took clients out to lunch, you paid for gas and mileage, you paid for health insurance premiums. And your accountant, who is excellent at their job, told you to write off every single legitimate expense to lower your tax burden. You successfully wrote off $120,000 in expenses. So you only had to pay taxes on $80,000 of income. You saved a fortune on your tax bill. Congratulations. You also just told the mortgage lender that you only make $80,000 a year. Every dollar you write off to save on taxes is a dollar you cannot use to qualify for a mortgage. It is a double-edged sword. So, how do you prove your income as a self-employed borrower? Get ready for a paperwork marathon. Lenders will typically demand the last 2 years of your full personal tax returns. That means every single page and every single schedule, especially your Schedule C if you're a sole proprietor. They will also want the last 2 years of your business tax returns if your business is structured as an S-corp or a partnership. They'll likely ask for a year-to-date profit and loss statement, or P&L, and your last several months of business bank statements to show cash flow. And just like with the W-2 employee, they're looking for a 2-year history. But for the self-employed, this rule is even more rigid. They will take your net income from the last 2 tax years, add them together, and divide by 24 to get your average monthly qualifying income. Let's look at an example. In 2022, your business had a net profit of $90,000. In 2023, you had a great year and your net profit was $110,000. The lender will add those, $200,000, divide by 24, and qualify you with a monthly income of about $8,333. They see a stable and, more importantly, an increasing income. That's a great sign. But what if it's the other way around? What if you netted $110,000 in 2022, but only $90,000 in 2023? Now you have a problem. This is a major red flag for an underwriter. They see a declining income and their first question is, why? Is this business failing? They will almost always use the lower, more recent income as your qualifier. In some cases, if the decline is significant, they might deny the loan altogether, fearing the business isn't stable. Consistency or an upward trend is everything. This is why tax planning is so critical for entrepreneurs who want to buy a house. For the 2 years leading up to your mortgage application, you might need to make a strategic decision to take fewer deductions, show a higher net income, and consequently, pay more in taxes. It's a bitter pill to swallow, but it can be the difference between getting a mortgage for the house of your dreams and getting a denial letter. Now, what about other types of income? Lenders will consider almost any legal, documented, and stable source of income. If you have rental properties, lenders will typically take the gross monthly rent and multiply it by 75%. That 25% reduction is to account for potential vacancies, repairs, and maintenance. So a property that rents for $2,000 a month will usually only add $1,500 to your qualifying income. What about alimony or child support? Yes, this can be used, but you have to prove two things. First, you need to show a history of consistent receipt, usually for at least 6 to 12 months. Second, you need to provide documentation, like a divorce decree or court order, showing that the payments are mandated to continue for at least 3 more years. And finally, what about retirement income? Social Security, pensions, 401k distributions. Lenders love this stuff. It's seen as one of the most stable and reliable forms of income there is. All you need is the award letter or statement showing the amount, and proof that you're receiving it. And here's a pro tip. If your retirement income is non-taxable, as is the case with some disability or Social Security benefits, many loan programs allow you to gross up that income, usually by 15 to 25%. This means if you receive $2,000 a month tax-free, a lender might count it as $2,500 of qualifying income, because that's what a W-2 earner would have to make before taxes to take home that same $2,000. So whether you're a salaried employee, a commissioned salesperson, a business owner, or a retiree, the principle remains the same. The lender's job is to peel back the layers and find a single, reliable, and predictable monthly income figure they can count on. It's not about how much money you have in the bank. It's about how much you can prove you earn month after month on paper. Understanding this half of the equation, the I for income, is crucial. But it's only half the story. Because a high income is meaningless to a lender if it's all being consumed by payments on your debts. They need to know how your income stacks up against your financial obligations. This brings us to the single most critical calculation in the entire mortgage process. A number so important it can make or break your application in a heartbeat. It's called the debt-to-income ratio, and it's what we're dissecting next. The debt-to-income ratio, or DTI, isn't just a piece of financial jargon. It's the gatekeeper. It's the bouncer at the club of homeownership. It's the one number that tells a lender more about your financial reality than almost anything else. Think of it this way. Your credit score tells the story of your past financial habits, how well you've handled debt. Your DTI, on the other hand, tells the story of your present financial capacity. It answers the brutally simple question. Based on how much you earn versus how much you owe, can you actually handle this new massive mortgage payment? So let's pull back the curtain. DTI is expressed as a percentage, and it's calculated by dividing your total monthly debt payments by your total gross monthly income. Simple, right? Well, the devil is in the details of what counts as debt and what counts as income. Lenders actually look at two different DTI ratios. The first is called the front-end ratio, also known as the housing ratio. This one is straightforward. It's your total future housing payment. And this is key, it's not just the loan payment, divided by your gross monthly income. This future housing payment is what the industry calls PITI, P-I-T-I. Principal, interest, taxes, and insurance. Principal is the part of your payment that actually pays down the loan balance. Interest is the lender's profit for giving you the money. Taxes are the property taxes you'll pay to your local government. And insurance is your homeowner's insurance. If you're buying a condo or a home in a specific community, you might have a fifth letter in there. For association dues or HOA fees. The lender bundles all of this into one number to see what percentage of your income will be dedicated solely to keeping a roof over your head. For example, if your gross monthly income is $10,000 and your total estimated PITI payment is $2,500, your front-end ratio is 25%. Easy enough. But the one that really matters, the one that gets all the attention, is the back-end ratio. This is the big one. The back-end ratio takes your entire future housing payment, the PITI we just talked about, and adds it to all of your other monthly debt obligations. Then it divides that total sum by your gross monthly income. So what are these other monthly debt obligations? This is where people get tripped up. The lender is looking at the debts that appear on your credit report. We're talking about car payments, student loan payments, personal loans, and the minimum monthly payments on all of your credit cards. It also includes court-ordered payments like alimony or child support. Let's be crystal clear about what is not included. Your DTI calculation does not care about your monthly grocery bill, your gas expenses, your utility bills, your cell phone plan, your Netflix subscription, or how much you spend on avocado toast. While those things absolutely affect your personal budget, They are not formal debt obligations reported to the credit bureaus, so for the purpose of this specific calculation, they're invisible. Now let's flip to the other side of the equation. Income. The I in DTI. This is another area where a lot of dreams get put on hold because of simple misunderstandings. Lenders need to be confident that your income is stable, reliable, and likely to continue for at least the next 3 years. If you're a W-2 salaried employee who gets a regular paycheck, this part is pretty simple. The lender will look at your pay stubs and W-2s to establish your gross monthly income. That's your income before any taxes or deductions are taken out. But what if you're self-employed? Or your income is based on commissions, bonuses, or overtime? This is where it gets more complex. A lender can't just use your best month ever as proof of income. They need to see a pattern of stability. So they will typically require 2 years of tax returns and will average your income over that 24-month period. If you made $100,000 one year and $50,000 the next, they're not going to use $100,000. They're going to use the average $75,000 per year, or $6,250 a month. This is done to smooth out the peaks and valleys and get a realistic picture of your actual earning power. The same principle applies to part-time work, rental income from other properties, or any other source of variable income. It must be documented, have a history, and be seen as likely to continue. Okay, theory is great, but let's make this real. Let's run the numbers for a hypothetical couple, Alex and Jamie. Alex has a salary job and brings in a gross monthly income of $6,000. Jamie is a freelancer and, after averaging the last 2 years of tax returns, has a qualifying gross monthly income of $4,000. Their combined gross monthly income is $10,000. That's the denominator in our DTI equation. Now for their debts. They have a car payment of $500 per month. They have student loans with a combined monthly payment of $300. And between a few credit cards, their total minimum monthly payments add up to $200. So their total existing monthly debt is $500 plus $300 plus $200, which equals $1,000. They found a house they love, and their mortgage broker has calculated that the total pity, principal, interest, taxes, and insurance will be about $2,800 per month. Now we can find their back-end DTI. We take their existing debt, $1,000, and add the new housing payment, $2,800. That gives us a total monthly debt obligation of $3,800. We divide that by their gross monthly income of $10,000. $3,800 divided by $10,000 equals 0.38. As a percentage, that is 38%. Alex and Jamie's DTI for this home purchase would be 38%. So, the million-dollar question is 38% good enough? The answer is, it depends. It depends entirely on the type of loan you're getting, and this is mission-critical information. For decades, the gold standard, the conservative rule of thumb, was the 28-36 rule. It meant your housing payment or front-end ratio shouldn't exceed 28% of your gross income, and your total debt, or back-end ratio, shouldn't exceed 36%. In our example, Alex and Jamie's front-end ratio is $2,800 divided by $10,000, which is 28%. Their back-end is 38%. So under this old-school rule, they'd be right on the edge. But things have changed. Modern underwriting, powered by automated systems, is more flexible. For a conventional loan, the most common type of mortgage, lenders generally like to see a DTI of 43% or less. This is the magic number for many programs. However, if you have strong compensating factors, like a high credit score, a large down payment, or significant cash reserves, these automated systems can often approve a DTI as high as 50%. Now, what about government-backed loans? This is where the rules get even more generous. An FHA loan, which is popular with first-time homebuyers, is much more forgiving on DTI. It's not uncommon to see approvals with a DTI of 47%, 50%, or in some cases with other strong factors, all the way up to a staggering 56.9%. This flexibility is one of the biggest benefits of the FHA program. Similarly, VA loans for veterans and USDA loans for rural areas also have more lenient DTI guidelines than conventional loans, often allowing for ratios well into the mid to high 40s or even higher, depending on the specifics of the file. So why is this one number so incredibly important? Because it's the ultimate measure of risk. A lender is about to hand you hundreds of thousands of dollars, and they need assurance you can pay it back month after month, year after year without financial distress. Your DTI ratio is the clearest snapshot of the pressure on your monthly cash flow. A low DTI suggests you have plenty of breathing room in your budget. A high DTI signals that your finances might be stretched thin, and any unexpected event, a job loss, a medical bill, could put you at risk of default. It's not personal. It's just a statistical assessment of your ability to carry the load. So you've run the numbers, you've calculated your gross income and your monthly debts, and you've found that your DTI is higher than you'd like. Maybe it's pushing that 50% limit, and you're worried you won't get approved for the house you really want. Is it game over? Not even close. In fact, this is where the real strategy begins. This number isn't set in stone. It's a variable you can influence. There are powerful lender-approved ways to actively lower this ratio, sometimes dramatically, and that's exactly what we're breaking down next. Let's start with the most direct approach: attacking the D in DTI, your debt. Most people think the best way to handle debt is to pay off the loan with the highest interest rate first. It's called the avalanche method, and financially, it's the smartest way to save money on interest over time. But when you're trying to qualify for a mortgage, financially smartest is not always strategically best. For mortgage qualification, the snowball method is often your secret weapon. That's where you pay off your smallest debts first, regardless of the interest rate. Why? Because the lender's DTI calculation doesn't care about your total debt balance. It only cares about your total monthly payments. Let me paint a picture. Imagine you have three debts: a $10,000 student loan with a monthly payment of $150, a $5,000 car loan with a monthly payment of $300, and a $1,000 credit card balance with a minimum payment of $50. Your total monthly debt for the DTI calculation is $500. The avalanche method says you should throw all your extra cash at that car loan because it probably has the highest interest rate. But even if you pay $1,000 toward it, your balance becomes $4,000, but your required minimum monthly payment is still $300. Your DTI hasn't changed one bit in the eyes of the lender. Now let's use the snowball method. You take that same $1,000 and you completely wipe out the credit card. Boom! It's gone. What just happened? That $50 monthly payment is now permanently erased from your DTI calculation. Your total monthly debt obligation just dropped from $500 to $450. If your gross monthly income is $6,000, your DTI just went from 43%, right on that risky edge for many lenders, down to a much safer 38%. You just gave yourself a 5-point DTI drop by ignoring the conventional wisdom and focusing on one thing: eliminating a payment line item entirely. Underwriters look for the total sum of your minimum monthly payments. When one of those payments becomes zero, it has a direct and immediate impact. It's a surgical strike. This strategy extends to other types of loans. Let's talk about car loans specifically, because they are often the biggest DTI killers for potential homebuyers. They have high monthly payments and can single-handedly push you over the qualification threshold. But there's a powerful little-known rule that some loan programs, particularly FHA loans, have. It's often called the 10 payments left rule. If you have an installment loan, like a car loan or a personal loan, and you have 10 or fewer monthly payments remaining, the lender may be able to completely disregard that payment in your DTI calculation. Think about the power of that. Let's say you have that $300 car payment, but you only have 12 months left on the loan. For a few $100s out of pocket, you could make 2 extra payments, bringing your remaining term down to 10 months. Suddenly, that $300 payment could vanish from the underwriter's spreadsheet. Your DTI plummets. This is a conversation you absolutely need to have with your loan officer. Ask them specifically, for the loan program I'm considering, does the 10-payment rule apply to installment loans? If it does, you've just found a massive strategic lever you can pull. Now, a word of caution on debt consolidation. On paper, it seems like a perfect solution. You take multiple high-payment debts, roll them into one new loan with a lower monthly payment, and your DTI improves. And it can work, but the timing is absolutely critical. If you apply for a new consolidation loan a week before you apply for a mortgage, you're waving a giant red flag. The lender sees a brand new loan, a hard inquiry on your credit, and it looks like you're desperately shuffling debt around to qualify. It makes them nervous. The smart way to use consolidation is to do it 6 months to a year before you plan to buy a house. This gives the new loan time to season on your credit report and shows a stable, responsible pattern of payments. Done right, it's a great tool. Done wrong, it can derail your application. So you've attacked the debt side. You've paid off small balances, you've explored the 10-payment rule. What's next? You have to flip the equation and focus on the I, your income. And this is where the single most important rule of mortgage lending comes into play. It's not about how much money you make. It's about how much money you can prove you make, in a way the lender considers stable and likely to continue. Let's start with the modern economy. Side hustles, freelance work, Uber driving, door dashing. This income is absolutely usable, but it comes with one non-negotiable requirement: a 2-year history. If you started a successful consulting gig 3 months ago and are pulling in an extra $2,000 a month, that's fantastic for your bank account, but for a mortgage underwriter, that income doesn't exist yet. They have no way to verify if it's a temporary fluke or a stable, long-term source of revenue. To make that income count, you need to have filed it on your tax returns for the past 2 consecutive years. The lender will take your Schedule C from your tax returns, add up the net income from the last 24 months, and divide by 24 to get your average monthly income from that source. If that income has been declining, they may not use it at all. If it's been stable or increasing, you're in a great position. The lesson here is to think long-term. If you plan to buy a house in 2 years, start that side hustle now and document every penny. This same principle of averaging applies to variable income from a traditional W-2 job. Think bonuses, commissions, and overtime. People get so excited when they get a huge $5,000 commission check the month before applying for a mortgage, thinking it will massively boost their qualifying power. It won't. An underwriter will look at that check and say, "That's nice, but what did you make over the last 24 months?" They will ask for your W-2s for the last 2 years and your year-to-date pay stubs. They will average out all of that variable income to find a conservative, reliable monthly figure. Consistency is 1,000 times more valuable than a single massive paycheck. Someone who earns a steady, extra $1,000 in overtime every single month for 2 years is in a much stronger position than someone who earned no overtime for 20 months and then suddenly got a $20,000 bonus. The first person shows a predictable pattern. The second person looks like a one-time anomaly. Pro tip: to make this process smoother, ask your HR department for a written verification of employment, or VOE. This is a standard form where they break down your base salary versus your overtime, bonus, and commission income over the last 2 years. Handing this to your loan officer up front shows you're prepared and makes the underwriter's job infinitely easier. Finally, there's one of the most powerful and underutilized income strategies, and it's called grossing up. This applies to anyone who receives non-taxable income. This could be Social Security benefits, certain disability income, or child support. Because this money isn't taxed, $1,000 of it in your bank account is worth more than $1,000 of W-2 salary, from which taxes are still to be taken. Lenders know this and they are allowed to adjust for it. They can gross up your non-taxable income by a certain percentage, typically 15 to 25%, to calculate a gross equivalent. Here's how it works. Let's say you receive $2,000 a month in non-taxable disability income. For DTI purposes, the lender might be able to count that as $2,500 a month. They take your $2,000 and multiply it by 1.25. That extra $500 of phantom income goes directly into your DTI calculation, potentially giving you tens of thousands of dollars in additional buying power. It's not magic. It's just accounting for the tax difference. But for people on fixed incomes, it can be the single factor that turns a denial into an approval. If you receive any form of non-taxable income, you must ask your lender if they are grossing it up. If they don't know what you're talking about, you might be talking to the wrong lender. By strategically eliminating monthly payments and ensuring every reliable stream of income is documented and calculated correctly, even grossed up, you are no longer a passive applicant. You are actively shaping your financial profile to meet the lender's requirements. You are taking control of the numbers, and that control is the key to getting the keys to your new home. But there's one more piece to this puzzle. A piece that's less about numbers and more about your history. And that history is all about one word: stability. Lenders are not just lending money to the person you are today. They are placing a 30-year bet on the person you will be tomorrow, next year, and a decade from now. They need to see a pattern of stability that gives them confidence your income will continue, allowing you to make those mortgage payments month after month, year after year. The two most important chapters in this story of stability are your employment history and your residency history. Let's start with the big one: your job. The unofficial rule of thumb in the mortgage world is the 2-year rule. Lenders love to see a consistent 2-year history of employment, preferably with the same employer or at least within the same line of work. Why? Because it demonstrates predictability. If you've been a software engineer for 5 years with the last 2 at the same major tech company, an underwriter can reasonably predict you'll continue to be a software engineer earning a similar income. You are a known quantity. Your income isn't a fluke. It's the result of an established career path. But what if you don't fit into that perfect little box? What if you just changed jobs 3 months ago? This is where panic often sets in, but it doesn't have to. The key is the narrative. Did you change jobs to take a promotion with a 20% pay raise in the exact same field? That's not a red flag. That's a green one. You're not just stable. You're upwardly mobile. The lender will simply need your offer letter, your first pay stub, and they will call your new employer for a verification of employment. As long as the story makes sense and shows progress, a recent job change can actually strengthen your file. The trickier situation is a complete career change. If you were a chef for 10 years and just became a real estate agent last month, a lender gets nervous. Your history as a chef doesn't predict your future income as an agent. In this scenario, you'll likely need to build up a track record in your new career, often a full 1 to 2 years, before a lender will feel comfortable using that new income to qualify you. Now, let's talk about the skeleton in the closet for so many applicants. Gaps in employment. Life happens. People go back to school, take time off to raise children, care for a sick relative, or get laid off during an economic downturn. Hiding these gaps is the worst thing you can do. Instead, you address them head-on with something called a letter of explanation or LOX. This is a simple, straightforward letter you write explaining the gap. From June 2022 to August 2023, I was out of the workforce to complete my master's degree in data analytics, which has enabled me to secure my current, higher-paying position at XYZ Corporation. Or, I was unemployed from March to September 2021 following a company-wide layoff. During that time, I actively sought new employment, as documented by my unemployment records, and subsequently accepted my current role. See the difference? You're not making excuses, you're providing context. You're controlling the narrative and showing the underwriter that the gap was a specific event, not a pattern of instability. This entire conversation gets a supercharger when we talk about the self-employed borrower. If you work for yourself, you are your own human resources department, and the lender will treat you as such. For you, the 2-year rule is not a guideline. It's a foundation. Lenders will almost always require your last 2 years of full filed federal tax returns, all schedules included. And here is the single most important thing for any entrepreneur, freelancer, or gig worker to understand. Lenders don't care about your gross revenue. They don't care that you billed $150,000 last year. They care about what you told the IRS your net income was after all your write-offs and deductions. If you wrote off everything but the kitchen sink to minimize your tax bill, you also minimize the income a lender can use to qualify you for a loan. They will take the net income from your last 2 tax returns, add them together, and divide by 24 to get your average monthly qualifying income. If your business is brand new and growing fast, this can be incredibly frustrating. You might be making $20,000 a month now, but if you only made $5,000 a month 2 years ago, the lender is going to use an average that's much lower than your current reality. For the self-employed, meticulous bookkeeping, clean profit and loss statements, and a strong 2-year history of stable or, even better, increasing net income is the absolute gold standard. Just as important as your employment story is your residency story. Again, lenders are looking for that 2-year history. They want to see where you've lived for the past 24 months. If you've been renting the same apartment for 3 years, that's perfect. It's another data point that paints a picture of a stable, predictable life. If you've moved several times, just like with employment, you need to provide the context. Were you in college? Were you on a military deployment? Did you move to follow a job opportunity? These are all perfectly logical reasons. The lender just needs to connect the dots. What they don't want to see is a series of unexplained, short-term moves that could suggest an unstable financial situation or an inability to meet lease obligations. Ultimately, you have to realize that an underwriter is a risk analyst. They are piecing together a puzzle of you using the documents you provide. Your credit report shows your history with debt. Your pay stubs and W-2s show your capacity to earn. Your bank statements show your ability to save. And your employment and residency history show your stability over time. When all these pieces tell a cohesive, positive story, your loan gets approved. When one piece is a little weak, a strong piece can often make up for it. This is what the industry calls a compensating factor. Let's say your debt-to-income ratio is a little high, right on the edge of the lender's guidelines. But you've been at the same job for 10 years, you have a perfect credit score, and you have 12 months of mortgage payments saved in the bank. Those are powerful compensating factors. The underwriter can look at your file and say, okay, the DTI is high, but this person's history is so stable, and their savings are so strong that I'm confident they represent a low risk. Conversely, if you have a borderline credit score, a brand new job, and very little in savings, there are no compensating factors. There's nothing to offset the risk. Every piece of your financial life works together to create a single impression. Your job, with the help of a good loan officer, is to ensure that impression is one of a reliable, responsible, and creditworthy borrower. You've gathered the evidence. You've prepared your statements. You've crafted the narrative around your credit, your assets, your income, and your history. You've built your case. Now it's time to submit that case to the final decision makers and navigate the last crucial steps to getting those keys. The loan package, your entire financial life story bound together, lands on the desk of a person you will never meet, the underwriter. This is the final gatekeeper. The loan officer was your coach, your advocate, your guide. The underwriter is the judge. They don't know your story. They don't know your dreams of painting the living room or setting up a home office. They know only the documents in front of them. Their job isn't to help you get a loan. Their job is to protect the lender from risk. They are the human embodiment of the lender's question. Is this a safe bet? They will re-verify everything. They'll run your credit again. They'll put your income, your assets, and your debts through their own rigorous calculations, using sophisticated software and their own deep experience. They are looking for one thing above all else: consistency. Does the income on your tax return match the income on your pay stub? Do the assets in your bank account align with the story you've told about your savings? Is that large deposit from 3 weeks ago truly a gift from your parents with the proper gift letter to prove it? Or is it an undisclosed loan that you'll have to pay back? Every single thread must connect. Any loose end, any inconsistency will be flagged. And then you'll get the news. But it's almost never a simple yes. It's something called a conditional approval. And this is where so many people panic. They see the word conditional and think something is wrong. But a conditional approval is a victory. It's the underwriter saying, based on everything I see, I am prepared to approve this loan, if you can provide me with a few more things. These are called prior to close conditions. These conditions are the underwriter's final checklist to eliminate every last shred of doubt. It might be something simple like your most recent pay stub that just came out, or an updated bank statement to show your funds for closing are still there. It might be more complex. They might ask for a letter of explanation for a recent credit inquiry. Why did you apply for that credit card 2 weeks ago? You'll need to write a simple signed letter explaining, I was offered a discount at a retail store and did not proceed with opening the account. Simple, honest, and direct. They might question a large, non-payroll deposit. You'll need to source it, providing a paper trail showing exactly where that money came from. Sold a car? You'll need the bill of sale and a copy of the check. Received a gift? You need that signed gift letter and proof the funds were transferred from the donor's account to yours. This is not the time to be vague. The underwriter is essentially saying, prove it. And you must. While you're gathering these final documents for your file, 2 other massive processes are happening in parallel, and either one can bring the entire deal to a halt. The first is the appraisal. Up until this point, the entire mortgage process has been about qualifying you, the borrower. Now it's time to qualify the house. The lender is about to give you hundreds of thousands of dollars, and the house is their only collateral. If you stop paying, they need to know they can sell that house and get their money back. So they hire an independent, third-party appraiser to determine the home's fair market value. The appraiser will walk the property, measure the square footage, note the condition, count the bedrooms and bathrooms, and identify upgrades. Then they will find recent sales of comparable homes in the immediate area, the comps, and make adjustments. Is your target house on a busier street than a comp? The value gets adjusted down. Does it have a brand new kitchen while the comp has an old one? The value gets adjusted up. It's both an art and a science. The number they come back with is one of the most pivotal moments in the entire transaction. If the appraisal comes in at or above the purchase price, everyone breathes a sigh of relief. The deal moves forward. But if the appraisal comes in low, you have a problem. Let's say you agreed to buy a house for $400,000, but the appraiser says it's only worth $380,000. The lender will only lend based on the lower value, so that $20,000 gap has to be bridged. You have 3 options. The seller can agree to lower the price to the appraised value. You can bring an extra $20,000 in cash to closing to cover the difference. Or if neither party can agree, the deal can fall apart completely. This is why a low appraisal is one of the most feared events in real estate. The second parallel process is the title search. If the appraisal is a physical exam of the house, the title search is a background check on its legal history. A title company scours public records, deed archives, and court judgments, looking for any clouds or defects on the title. They're asking, does the seller have the undisputed, legal right to sell this property? Are there any old, unpaid mortgages? Any contractor's liens from a kitchen remodel 5 years ago? Any property tax issues? An old heir from a past owner who might have a claim? Their job is to ensure that when you get the keys, you are getting clean, clear, and undisputed ownership of that property. If they find issues, they have to be resolved before closing, which can sometimes cause delays. Once your final conditions are submitted and accepted by the underwriter, the appraisal is in and approved, and the title search comes back clean, you will finally hear the 3 most beautiful words in the mortgage world: clear to close. This is it. The finish line is in sight. The underwriter has given their final stamp of approval. The lender is fully committed to funding your loan. From here, a legal clock starts ticking. You will be sent your closing disclosure, or CD. This is the final official breakdown of your loan, the interest rate, the monthly payment, and the exact amount of money you need to bring to closing down to the penny. By law, you must receive this document at least 3 full business days before you are allowed to sign your final loan documents. This is your mandatory cooling-off period. It's designed to prevent surprises at the closing table. You need to take this time to review every single number on that CD and compare it to the loan estimate you received at the very beginning. Do the numbers match up? Are the fees what you expected? If anything looks off, you must speak up now. Finally, closing day arrives. You'll sit at a table with a closing agent or an attorney, and they will present you with a stack of paper that looks like a novel. You'll sign your name over and over again. You'll sign the promissory note, your legal promise to repay the loan. You'll sign the mortgage or deed of trust, the document that gives the lender the right to take the house if you don't pay. You'll sign tax forms and disclosures. Your hand will cramp, but with every signature, the reality of what you've accomplished begins to sink in. You'll provide a cashier's check or initiate a wire for your closing costs and down payment. The funds from the lender will arrive, and then a moment of quiet. The closing agent will make a few phone calls, type a few things into a computer, and then look up and smile. And they will slide a set of keys across the table. They're yours. So, after all of this, the applications, the documents, the underwriting, the appraisals, what do lenders actually look for? It's not just one thing. It's the sum of all the parts. They aren't looking for a perfect borrower because perfect borrowers don't exist. They are looking for a predictable one. They look for a story of stability, told through your employment history. They look for a story of responsibility, told through your credit report. They look for a story of capacity, told through your debt-to-income ratio. They look for a story of commitment, told through your assets and your down payment. And they look for a story of honesty, told through the clear, consistent, and verifiable documentation you provide. The entire mortgage qualification process is a journey in proving you are a reliable partner. It's about demonstrating that you are a calculated risk worth taking. It's daunting, it's invasive, and at times it's incredibly stressful. But it is not a mystery. Now you know the rules of the game. You know what they're looking for, why they're looking for it, and how to prepare. The lender isn't looking for perfection. They're looking for a partner they can trust. And now you know exactly how to show them you're the one.